1929. The stock market crashed. Fortunes vanished overnight. Banks collapsed. Businesses failed. Millions lost everything. Their savings, their homes, their future. Everything they had worked for was gone in a matter of days. But not everyone lost everything. Some people, a small group, walked away not just intact, but wealthier than before. They didn't get lucky. They didn't have insider information. They had something else. They owned the right assets. The assets that survive when everything else collapses. 1971. President Nixon ended the gold standard. The dollar, which had been backed by gold for decades, became nothing more than paper, faith-based currency. And within years, inflation exploded. Savings accounts lost half their value. Wages couldn't keep up with prices. The middle class was gutted. But again, some people were protected. The same small group. They held the same three assets. And while everyone else struggled, they thrived. 2008, the financial crisis. The housing market collapsed. Lehman Brothers fell. Bear Stearns disappeared. Trillions of dollars evaporated from the global economy. Retirement accounts were destroyed. Jobs vanished. Entire industries crumbled. And once again, the same pattern. The same three assets. The people who held them didn't just survive. They came out ahead. 2020. The pandemic. Governments shut down economies. Printed trillions of dollars. Inflation surged. Supply chains broke. And while most people saw their purchasing power decline, that same small group held steady. Protected. Insulated. Safe. For collapses. For different crises. For different causes. But the same three assets survived every single one. This isn't a coincidence. This isn't luck. This is pattern recognition. Throughout history, whenever economies collapse, currencies fail, or governments fall apart, three types of assets consistently hold their value. They've done it for over a century. Through world wars, through depressions, through hyperinflation, through financial panics. Every time. And right now, as we stand on the edge of another crisis, those three assets are the only things standing between wealth and ruin. Most people don't know what they are. Most people are still holding their wealth in things that collapse. Dollars, bonds, stocks tied to dying systems. And when the next crisis hits, and it will hit, those people will lose everything just like the people in 1929. Just like the people in 2008. But you don't have to be one of them. The three assets I'm about to show you have survived every economic collapse since 1900. Not some of them. All of them. They survived the Great Depression. They survived 2 world wars. They survived the collapse of the gold standard. They survived the stagflation of the 70s. They survived the dot-com crash. They survived 2008. They survived COVID. And they will survive whatever comes next. These aren't speculative investments. These aren't get-rich-quick schemes. These are stores of value that have been tested by time, by war, by inflation, and by collapse. And they have never failed. The first asset is something humans have valued for over 5,000 years. Empires have risen and fallen around it. Wars have been fought over it. And no matter what happens to governments or currencies, it always holds value. The second asset is something most people overlook. It's not glamorous. It's not exciting. But it's one of the most consistent wealth preservers in human history. The wealthy have known about it for centuries, and they've quietly accumulated it while everyone else chased trends. The third asset is the one most people will never own, not because they can't afford it, but because they don't understand it, and that ignorance costs them everything when the collapse comes. If you want to protect your wealth, if you want to survive the next crisis, then you need to understand these three assets. You need to know why they work. You need to know how to acquire them. And you need to act before it's too late. Stay with me, because what I'm about to show you could be the difference between thriving and losing everything. And if this information is valuable to you, subscribe, because we're going to keep unraveling the patterns that protect wealth when everything else falls apart. The first asset is something humans have valued for more than 5,000 years. Long before stock exchanges existed, long before central banks, credit markets, or paper money, civilizations rose around it. Empires stored it in vaults. Armies crossed continents to seize it. And when those empires collapsed, when currencies disappeared, this asset remained. Gold. When trust and money breaks, gold doesn't need trust. When governments print endlessly, gold doesn't multiply. When systems fail, gold doesn't disappear. During the Great Depression, banks closed their doors. People lost access to their savings overnight. But gold holders didn't lose purchasing power. When the dollar was officially devalued in the 1930s, gold quietly adjusted upward, preserving wealth while paper savings were destroyed. The same pattern repeated in the 1970s. Inflation exploded after the end of the gold standard. Prices rose faster than wages. Savings accounts bled value year after year. Gold moved in the opposite direction, absorbing the loss created by currency debasement. In 2008, when financial markets froze and confidence cracked, gold surged again. And during the pandemic, as trillions were printed and currencies weakened, gold didn't panic. It did what it has always done. It held. Gold doesn't depend on quarterly earnings. It doesn't rely on political stability. It doesn't promise growth. Its role is simpler and far more important. It preserves value when everything else becomes uncertain. But protection doesn't stop there. Because history shows that when crises deepen, people don't only look for something to store value. They look for something tangible, something useful, something tied to real life. That's where the second asset enters the picture. Land, not speculative land. Not overpriced urban real estate driven by leverage. Productive land. Useful land. Land that feeds people, houses them, powers systems, or connects infrastructure. Every major collapse follows a familiar sequence. Financial assets fall first. Currency weakens next. And then attention shifts back to what actually sustains society. During the Great Depression, farmland didn't vanish. It produced food when money failed. During wars, land became strategic power. During inflationary periods, land adjusted with rising prices instead of being erased by them. Even in 2008, while leveraged real estate imploded, productive land held its ground. In many cases, it quietly appreciated while financial assets burned. Land doesn't move fast. It isn't exciting. It doesn't trend on social media. But it has one quality that matters more than speed. It endures. You can't print land. You can't duplicate it. And no matter what happens to markets or currencies, people will always need space to live, grow, build, and survive. Those who understand this accumulate it patiently. Those who don't usually sell it under pressure, only to watch it consolidate into fewer hands after the crisis passes. But even land has limits. Because as collapses deepen, ownership tied to borders, regulation, and centralized control can be challenged. Laws change. Governments intervene. What once felt permanent can suddenly feel fragile. That's where the third asset separates itself from the rest. It isn't something you swipe for on a screen. It isn't something created by policy. And it isn't something that disappears when markets close. It's control over productive capacity. The systems that keep societies functioning when everything else is unstable. Energy, food production, transportation, logistics, infrastructure. The foundations that daily life depends on, whether people realize it or not. In every crisis, countless businesses fail, but a small group becomes indispensable. During the Great Depression, companies tied to essential production survived. In the inflationary 70s, businesses with pricing power endured. In 2008, firms embedded in the core of the economy weren't allowed to fail, not out of fairness, but necessity. During the pandemic, the same dynamic played out again. Small operators collapsed. Essential systems expanded. Market share concentrated. Power consolidated. This asset isn't about hype or speculation. It's about position. Being necessary. Being upstream. being difficult to replace. That's the common thread connecting all three. Gold exists outside the system. Land anchors value in reality. Productive control embeds wealth into necessity. Together, they don't eliminate risk. They change how risk behaves. They don't promise rapid growth. They reduce the chance of permanent loss. And history is clear about one thing. When collapses happen, wealth doesn't vanish. It moves, quietly, predictably, from those exposed to fragile systems to those anchored in assets that survive when those systems fail. There's a reason these three assets keep ending up in the same hands after every collapse. It's not because they're secret. It's not because they're inaccessible. It's because most people are pushed slowly and invisibly into holding the opposite. Modern systems don't encourage preservation. They encourage participation. Participation in currencies that lose value over time. Participation in markets that reward leverage over patience. Participation in growth narratives that work perfectly until they don't. For decades, people are taught that saving money is responsible, that holding cash is safe, that pensions, bonds, and paper promises will be there when needed. And during stable periods, that belief seems justified until stability breaks. When inflation accelerates, cash doesn't scream. It quietly erodes. Purchasing power fades in the background while life becomes more expensive. People feel pressure, but they rarely connect it to the system itself. When markets fall, most portfolios are exposed in the same direction. Stocks, bonds, funds, pensions, all tied to confidence, liquidity, and centralized control. When confidence cracks, everything moves together. That's why collapses feel so sudden. It isn't that wealth disappears overnight. It's that people realize, all at once, that what they own was never anchored anything solid. History repeats this lesson relentlessly. In 1929, people trusted banks. In 1971, they trusted the dollar. In 2008, they trusted financial engineering. In 2020, they trusted emergency stimulus. Each time, the promise was different. Each time, the outcome was the same. Those who relied on systems lost control. Those who held assets outside or beneath the system retained it. And here's the uncomfortable part. Most people don't lose wealth because they make bad decisions. They lose it because they make common ones. They hold what everyone else holds. They believe what everyone else believes. They react when everyone else reacts. By the time panic becomes visible, the transfer is already underway. Gold doesn't move because of fear. It moves because trust weakens. Land doesn't spike because of headlines. It consolidates quietly when pressure forces sales. Control over productive systems doesn't announce itself. It expands while attention is elsewhere. This is why wealth concentration accelerates after every crisis. Not because the wealthy predicted the collapse perfectly, but because they were positioned in assets that behave differently when stress enters the system. And this is where timing matters. Most people start thinking about protection only after volatility appears, after prices move, after policies change, after headlines turn dark. By then, assets that preserve value are no longer ignored. They're crowded, expensive, politicized. The window isn't when collapse is obvious. It's when complacency still feels comfortable. That's a pattern across every crisis since 1900. Calm first, dismissal second, shock third, then realization. When repositioning becomes difficult, expensive, or impossible, the people who fare best aren't the ones who panic early. They're the ones who never needed to panic at all. They built their wealth on things that don't depend on optimism to function. And when the system stumbles, they don't rush for exits. They become the exit. When you step back and look at history without emotion, a simple truth becomes obvious. Collapses don't destroy everything equally. They don't hit all assets the same way. They don't punish all forms of wealth uniformly. They expose weakness. And they reward resilience. The three assets that survive every collapse share the same core characteristics. They are scarce. They are difficult to create quickly, and they do not rely on promises. Scarcity matters because abundance is always the enemy of value. When governments need funding, they create currency. When institutions need liquidity, they issue debt. When markets chase growth, they multiply paper claims. But these assets cannot be multiplied by policy decisions. Gold cannot be printed. Land cannot be copied. Control over productive systems cannot be diluted without consequence. This is why, during periods of expansion, these assets often feel boring. They don't offer explosive returns. They don't dominate headlines. They don't generate excitement. They simply endure. And endurance is invisible until it becomes rare. When confidence collapses, people don't suddenly desire innovation. They desire certainty. They look for things that existed before the crisis and will exist after it. Things that don't depend on central banks, quarterly earnings, or political stability. That instinct is ancient. During Roman debasement, people hoarded metal. During medieval collapses, land determined survival. During industrial shocks, ownership of production decided who recovered first. The modern world hasn't changed this dynamic. It has only disguised it. Technology accelerated finance. Globalization multiplied exposure. Leverage magnified outcomes. But underneath it all, the same structure remains. Assets tied to systems rise and fall with those systems. Assets tied to reality persist. This is why gold quietly resets higher after every crisis. Why land consolidates into fewer hands. Why productive ownership becomes more centralized when chaos passes. None of this requires conspiracy. It's simply how humans behave under pressure. When uncertainty rises, people retreat toward what feels permanent. And here's what most miss. These assets don't protect wealth because they grow fast. They protect wealth because they don't break. They don't require optimism to function. They don't need trust to retain value. They don't collapse just because confidence does. That's the difference between preservation and speculation. Speculation depends on timing. Preservation depends on structure. And once you see that distinction, collapses stop feeling random. They feel cyclical, predictable, almost mechanical, not in timing, but in outcome. Every collapse strips away illusions. Every recovery reveals who was positioned correctly before the storm. And the uncomfortable reality is that by the time most people understand this, the window has already narrowed. Once you understand this pattern, it changes how you see the world. News stops feeling chaotic. Crises stop feeling random. And fear loses much of its power, because you realize that collapse doesn't create new rules. It reveals old ones. The question is never if systems will be stressed. It's which parts were fragile to begin with. Currencies fail because they depend on confidence. Markets break because they depend on leverage. Institutions fall because they depend on trust. But the assets that survived every collapse since 1900 don't depend on any of that. They depend on scarcity, on physical reality, on human necessity. That's why they outlive empires, governments, and monetary systems. And this isn't about predicting the next crash. No one knows the exact timing. It's about positioning yourself so timing no longer matters. When your wealth is anchored to things that don't vanish when confidence fades, volatility becomes noise instead of danger. You stop chasing safety. You stop reacting to panic. You stop relying on promises that only work in calm conditions. Instead, you build around permanence. That's what people who came out ahead in 1929 understood. That's what protected wealth in 1971. That's what mattered in 2008. And that's what quietly worked again during the pandemic. Different crises, same outcome. History doesn't reward optimism. It rewards preparation. And the preparation isn't complex. It's just uncomfortable because it goes against what most systems promote. Holding assets that survive collapse often feels unnecessary until it's essential. If there's one lesson repeated over the last century, it's this. Wealth isn't lost in crashes. It's transferred, and the direction of that transfer is determined long before headlines appear. If this way of thinking resonates with you, stay here. This channel exists to break down these historical patterns, not to create fear, but to replace confusion with clarity. Because once you see how wealth actually survives collapse, you stop being surprised by history. You start learning from it. And that's how you stay standing when everything else falls apart.